Hi, and welcome to this morning's early concise highlight on Friday, March 18th, 2016. It is currently 7 a.m. U.S. Central Time, and it's going to be concise because so much of the actual price activity on the charts and the technical update and the market observations from after yesterday's close below Thursday morning's Global View video analysis is still consistent with everything the markets are doing, even if there's been just a bit of further movement this morning. And the main thing is that the central banks have been so accommodative over the last week and a half, starting with the ECB last week, which is very accommodative, and the BOJ Tuesday maintaining its accommodation, Fed becoming more accommodative on this Wednesday, and yesterday morning the Bank of England, with just a simple statement, no press conference this time, also remaining quite accommodative. And we have to ask what all this means to the markets. Well, it's been a bad news is good news market, so a little bit further weakish data coming into this morning, like that German PPI and the S&P 500 future rolling over to the June now, of course, is up 5 at 2035. Now, this is important, of course, because after getting out above the more major resistance range at 2010 to 20, even though this June contract had a discount to the March contract that just expired at the close yesterday. So when the March contract has recently been up to the 2020 area, this has been down, or somewhat above it, this has been down around 2010 to somewhat above it. And the key was whether the June contract, in the wake, partially in anticipation, but especially in the wake of the FOMC on Wednesday and the Bank of England yesterday, could indeed push above 2020, and it stalled on Wednesday after the Fed right into the 2020 area, made a high of 2031 though on the lead contract, and after dipping early yesterday where the bears might have maintained control of the market, it started pushing up out above 2020, and the next resistance above that was indeed 2035. So there we were. And not a big surprise once the bears lost control after the early attempt to pressure the market. Further resistances are up at 2050, 2060 area. The ultimate resistance starts up at 2075 and extends up to 2085. Lower supports at this point, of course, will be right back at 2020 to 2010. And it's interesting on this contract how much congestion occurred, even though it was at a discount, when the front month was attacking 2020 area with a larger than usual $10 discount. This was back churning in some congestion around 2010, using this here down to maybe 2009. So that's the level the bears really ultimately need to get it back below to say they can turn it over to the downside. What also was most interesting yesterday morning was the degree to which the market, let's get a vertical cursor going, the market on both the 60-minute and 30-minute MACDs had remained slightly out above their upper runaway band on the activity going back to late session on Wednesday. Then yesterday morning, if the market had dipped further, it would have been a rollover back off of the attempt to strengthen further above the runaway band. But what happened in each case is as you got out above 2020, the 30-minute and 60-minute MACDs remained out above the upper runaway band, and unless the bears can really knock the market very quickly after that, tends to feed off itself. So we had a technical indicator that also showed us that once it's above 2020, it was in a critical place and ready to strengthen further. And that pretty much does it for the short-term view of the S&P 500.